Hey everybody, welcome to the morning market briefing. It is Wednesday, October 12th, 2022. Hope you are doing well. Just me today. Ben and Tom are on their way out to a conference flying out this morning. So just stuck with me really for the next couple of days. We'll probably get a couple other folks to join us, but appreciate you for being here. First and foremost, thanks to everybody that came out to the macro presentation, whether that was in person or on Zoom yesterday. We really appreciate the engagement. We will have that, if you happen to miss it, we will have that in video form and PowerPoint form, all that good stuff. Probably, hopefully by the end of the day today. If not, we'll probably have it up on the blog tomorrow. So if you missed that, be sure to check it out. We'll probably send it out via email as well, but you can check out the Narwhal Capital blog for all of that. As we open up today, quickly just kind of jumping in with market review. Obviously, a little bit of turmoil in markets yesterday. We actually closed yesterday at the second lowest point for the S&P closing wise of the year. So not great. Not so ironically, I guess, really the 10-year yield closed at 3.93, which was the second highest level that we had seen on the 10-year this year. We're continuing to see, if you were at the macro presentation, we talked at length about this, but really just continuing to see this ongoing seesaw give and take between yields on fixed income and declines in equity. Those things are really going hand in hand. As it may sound like a broken record, but the theme continues to be Fed policy, anticipation of Fed policy, and the fight against inflation. That's really the number one driver in the markets right now, whether you're looking at fixed income, whether you're looking at equity. So both on stocks and bonds, continuing to see some challenges there. Right now, as we look though, we are seeing some green for futures. Dow futures are up 61 basis points. S&P futures up 75 basis points. The Nasdaq futures up close to 1%. So a little bit of green in the market and a little bit of news. So we'll kind of jump right into that stuff. First up, big impacts that we're starting to see in the mortgage and the home buying business. We talked about this yesterday as well. So for a fuller breakdown, you can check that out. But as we're sitting here looking at 30-year mortgage rates in the 7% range, the average I think right now is 7.13%. As you would expect, that is having a massive impact on mortgage applications. According to the Mortgage Bankers Association, mortgage application fell another 2% this week. That is a big decline. What's interesting is they actually run their own mortgage index, which reflects a little bit of everything. It takes into account 30-year mortgages, 15 years, fixed rate, floating rate, refinances, all of that stuff. I will be honest, I don't totally understand the exact methodology, but I think the scale of that index is really impactful. Well, last year, that index was reading at 686. So 686. Right now, it's reading at 214. So down about more than two thirds year over year in terms of the volume that they're seeing across a wide array of mortgage products. So definitely having an impact, as you would imagine, when interest rates go up and affordability goes down, people start to think and rethink potential home purchases. I don't know who's refinancing their home right now, but they must have a really high interest rate if they're attracted to these numbers that are in the 7%. So kind of interesting to see the impact we're having there. We are actually, as it relates to volume of 30-year applications, we are at the lowest level we've seen since December of 1999. So very low volume. That is starting to have an impact on prices. Nationally speaking, we're still seeing real estate move relatively quickly in good areas, and we're still seeing in those areas pricing be slightly above asking. The biggest change we've seen is there's not as many buyers coming into the market. There's not this flood of 30 offers from people who have not even seen the home yet. It's getting much more into kind of a more reasonable, more traditional environment. I was actually talking with one of the bartenders yesterday at Marriott Country Club, also has a home inspection business. He said he's starting to see things slow down, but hasn't seen a huge decline. And the biggest reason for that is, he said, we really don't get to the inspection part of the game until there is an offer and until we get into that due diligence period. He said we're still getting there relatively quickly. It just may not be as much of a process to wade through all of the offers, but he is seeing some slowdown. I thought that was pretty interesting. We're seeing pricing down. There's a report out today that we're seeing some pricing declines in real estate, specifically in some of these trendy, hotter areas. Austin, Texas, which has grown tremendously, is down 6% on average home prices from their peak. Not a huge decline, and not surprisingly, perhaps, real trouble in some of these California cities. Los Angeles and San Francisco, home prices down 11% from their peak. San Diego and San Jose down 8%. So we're starting to see pockets where home prices are declining. I think it's really important to note, though, that even an 11% decline like you might be seeing in San Francisco, that's declining really off of all-time highs. So we are seeing some decline, but this is very, very different than the 2008, 2009 housing crisis, which we talked about. Interestingly, even in this odd mortgage environment, people are remaining committed to their plans as it relates to trying to push these products. One group, Lenders One Cooperative, which is essentially an affiliation of a bunch of mortgage lenders, they announced in March that they were going to be coming inside of Walmarts and setting up in-store experiences in which people could apply for mortgages and refinancing of mortgages, all that good stuff. They're moving forward with that. It was announced that they're opening their first 3, 2 of them in New Jersey, 1 in Florida, and so they're pushing forward with that plan. Moving over to kind of the other side of the market and leaving real estate, going into medicine, Merck and Moderna have announced a joint development on a personalized cancer drug. Pretty interesting development here. It's in phase 2. They started working together on this back in 2016, but Merck has now decided that they're going to exercise their option to continue jointly developing this. So what this looks like is Merck is going to pay Moderna $250 million for the right to continue developing this, to basically have a role inside of the development of this drug. And ultimately, the two companies will split the profits from it. So an interesting proposition here. You don't always hear about these deals until they actually go through. This has been in the works for 6 years at this point. Merck has decided they want to move forward with it, and I think it makes a lot of sense. Anytime we look at any kind of deal, whether it's mergers and acquisitions, one company buying another, or something like this, we always try to figure out, does it make sense for the companies? I actually think this makes a lot of sense for both companies. Merck has had a very, very solid year of equity performance. So they're in a relatively good financial foothold compared to a lot of market participants, not even compared to just drug companies. So year to date, Merck stock's actually up 18%. Obviously, the market's down significantly. And so they're in a good position. Meanwhile, Moderna is down about 55%. And so Moderna needs probably all the help they can get. And that may mean $250 million check that Merck is writing may be worthwhile. So they're in phase 2 on this drug. They're testing it with high-risk melanoma patients and trying to push it forward to actually market it. They will share the cost of development. They will share the cost of marketing. They will share the profits there. Meanwhile, Eli Lilly, a company that we actually talked about also yesterday in the macro presentation, is starting to get upgraded. JP Morgan came out and upgraded the stock. Stock's up about 1% pre-market. JP Morgan analysts had a price target at $355 a share. They've raised it to $380. What's interesting about this is really, I think it lends itself to some of the opportunistic catalysts that we mentioned yesterday in the presentation. We're looking for companies that are stable. We're looking for companies that have proven revenue streams. We're looking for companies that are not entirely reliant on just raising more money, companies that don't have too much debt. Lilly checks a lot of those boxes, but we're really excited about their drug pipeline and some of the things they're getting out. We mentioned the diabetes drug yesterday in the presentation that's also being tested and trying to get approval from the FDA just for pure weight loss. It looks like JP Morgan kind of took notice of this. Hey, there's an actual catalyst here where this could be pretty attractive. And I think that's good news. We talked about the nuance yesterday of, we're in this cycle where bad news tends to be perceived positively, good news tends to be perceived negatively. We really need to get to a spot in which market participants are really thinking about putting their toes into the water. And I think this is an example of that, even in this market environment that we just touched on. Second lowest close of the year yesterday. There are still opportunities, and JP Morgan recognizes one. Now, we don't think all that highly necessarily of the banking analyst community at all times. A lot of times they just kind of follow the prices. This is a little bit different. Their price target on the stock was higher than where the stock is trading now, and they've said, hey, we actually think it's worth a little bit more. So glad to see that for Eli Lilly. They're certainly benefiting from that, at least in the hyper short term. And that can have an impact on markets. You have to pay attention to the analyst community because they are giving advice and recommendations to massive market participants. And so that can have an impact. And it's nice to see that they're somewhat aligned with us. We do have the CPI report coming out tomorrow morning at 8:30. So we're going to be live for that, and we'll be breaking that down. We'll probably do it at the tail end of the call. I'll probably get somebody else to come in just so we can, have a little bit of background research going on while we're talking about stuff, and so that'll be helpful. But we also got some economic data coming in today in the form of PPI, and so right now we are seeing PPI come in. The yearly rate of PPI came in at 5.6% on the core level, 8.7%. Notably for this, if you're looking at, well, what's the real expectation, we saw core PPI as well as producer PPI, so producer price index at large, come in at 0.4%. The expectation was 0.2%. What that means is this, which is also very much a measure of inflation, yet again, we're coming in above expectations. I mentioned just a moment ago that Nasdaq Futures were up about 1%. They're now up about 0.25%. So the market is digesting this relatively quickly. Prices are climbing faster than people expected. Once again, sounds like a little bit of a broken record. Now, is this going to really drive Fed policy making? Not so much. So the CPI number is going to be a much better read on where inflation is coming in. So tomorrow, we're really going to be looking for that core inflation number. It's expected to increase by 0.4% on a month-over-month basis, which would equate to 6.5% year over year. If that is the case, honestly, I think that would be relatively good news, but we continually get surprised by data that is higher, at least relative to analyst expectations. We're continuing to see data come in higher than what's expected. So right now, even just given what we just saw in PPI, if I had to bet, I would expect that CPI is probably going to run a little bit hotter than what's expected. The year-over-year number on that core figure for CPI is 6.5%. I would take the over there. The total CPI figure is expected to be at 8.1. I think that could be roughly in line. We do have some things that have had some stability, whether it's energy costs, et cetera. So going to be an interesting day tomorrow. We will also get initial jobless claims as we do every Thursday morning. So we'll keep an eye on that. For now, though, we're going to wrap it up. We will be back tomorrow. At least I will. We'll probably bring somebody else in on the call, and we'll talk to you in almost 24 hours. Hope you guys have a great day. Talk to you soon.